Okay, now move on to the last topic, the balance of payments crisis and capital flight. In practice, the central bank may find it undesirable or infeasible to maintain the current fixed exchange rate. For example, the central bank is running short on reserves or facing high domestic unemployment. In such situation, the central bank feels infeasible to maintain the current fixed exchange rate. So if the market participants know the central bank may respond to such situations by devaluing the currency, it will be unreasonable to expect the current exchange rate to be in place forever. So therefore, if the market participants know the central bank may respond to such situations by devaluing the currency, if the market participants know the possibility of devaluation by the central bank, then the future expected exchange rate can change. So such change in future expected exchange rate can cause the collapse of fixed exchange rate system. Okay, so the balance of payment prices is a sharp change in reserves sparked by a change in expectations about the future exchange rate. Then, how does the balance of payments crisis occur under the fixed exchange rate? So now I share the graph. Sorry. So this is the graph, so money market and exchange rate market graph. So the upper graph show that exchange rate market, the horizontal axis is domestic interest rate and the vertical axis is exchange rate. The bottom graph is showing the money market equilibrium. The horizontal axis is also domestic interest rate and the horizontal axis is real domestic money holdings. So in the money market, there is two lines. First one is real money supply here and domestic money demand here. In the exchange market equilibrium, there are two graphs, the domestic interest rate graph and also falling the return on foreign deposit. Return on foreign deposit. Okay. So suppose that initial equilibrium is 0.1 and 0.1 dash here. So the initial equilibrium exchange rate is E0 and initial money supply is M1 over P. So suppose a sudden deterioration in the current account. So which leads to the foreign exchange market to expand the government to devaluate in the future and adopt a new exchange rate, E1. Here, so which is greater than V1? So like here, so the expected exchange rate changes according to the change in exchange rate, and the curves measure the expected domestic currency currency return on foreign currency deposits shift to the right here. Okay. So according to the expected exchange rate change, the curves measures the domestic currency return on foreign currency deposit. Here, shift to the right. And also here is the new expected exchange rate, E1. Then, also, here is change. The domestic interest rate should be equal to this term, this value should be greater than, sorry. Domestic interest rate equal to this level. And now the falling interest rate, the current domestic value on foreign deposit increases from this at this level. And E1 is the new expected exchange rate. So therefore, this is the new expected return on foreign assets. So therefore, here, domestic interest rate is less than the new expected return on foreign assets. So therefore, excess demand for foreign currency assets is happen. Here. So to prevent, so therefore, it moves to here and moves to here. So to prevent the currency depreciation, central bank must sell reserves on this shrinks the domestic money supply M1 to M2 from here to here. And interest rate now equal to this level. So this line moves to the right. Then new equilibrium is the point of 2 dash and point 2. Again, now I explain again. So first, the initial equilibrium is at point 1 and point 1 dash, and the initial expected exchange, initial exchange rate is E0, and also initial expected exchange rate is also E0. Suppose that sudden deterioration in the current account, which leads to the foreign exchange market to expect the government to devalue in the future and adopt a new exchange rate E1 to E2. So sorry, E0 to E1. So like this. So governments will set the new exchange rate at this level. This is just example. So when people expect the government action, like the changing E0 to E1, people's expectation of exchange rate will change from E0 to E1. So reflecting the expected exchange rate change, the expected domestic currency deposits, the currency return on the foreign currency deposits here changed by reflecting this expected exchange rate change. So because expected exchange rate change, then the current deposits, so the foreign currency deposits return will be increased. It will be increased. So this is because of the expectation change. Okay. Now also interest rate also change. So this is because of the interest parity condition. So according to the interest parity condition, the domestic interest rate should be equal to the foreign interest rate plus the expected depreciation, rate of depreciation. So now exchange interest rate, sorry. So the domestic interest rate should be equal to this level. But new expected return on foreign assets change due to this expectation change. So the new expected return on foreign assets increases, and it will be larger than the domestic interest rate. So in this case, the currency depreciates, reflecting the interest rate difference. So to prevent currency depreciation, the central bank must sell reserves and thus shrink the domestic money supply. So therefore, money supply goes down from M1 to M2. Then, by reflecting this decline in the money supply, domestic interest rate will be larger and at this level. So this level is the expected return on foreign assets. So then this line goes right, sorry. This line goes right. Then equilibrium is 0.2. So 0.2 is the new equilibrium. So under the 0.2, exchange rate is still E0, but the expectation of the exchange rate is changed from E0 to E1. So people now believing the future exchange rate is E1, but the current exchange rate is still E0. Okay. Okay. In summary, the expectation of future devaluation causes a balance of payments crisis marked by a sharp fall in reserves. So you know that this is so there is a decline of monetary supply, sharp in reserves, and the rise in the home interest rate above the world interest rate. So you know that. So now at the new equilibrium, this is the new domestic interest rate level. So which is greater than R star, so which is foreign world interest rate level. So now the domestic interest rate is greater than the world interest rate level. So unexpected devaluation causes an abrupt rise in foreign reserves together with a fall in the home interest rate below the world rate. So the expectation of future devaluation causes actual devaluation. So which is called self-fulfilling crisis. The central bank sells reserves to prevent currency depreciation, but the reserves they hold are limited. So if the reserves are gone, devaluation occurs. So the expectation, just expectation. So expectation of the future devaluation causes the monetary supply change by central bank to prevent to keep the fixed exchange rate, and then causes actual devaluation. So central bank try to maintain the fixed exchange rate by selling reserves, but reserves are limited. So if the reserves are gone, then devaluation occurs in reality. Okay, so this is self-fulfilling crisis. Okay, now is the time to end this lecture. So we covered under the fixed exchange rate how the monetary and fiscal policy affect the economy. And also we covered how does the devaluation or revaluation affect the economy. Also, we covered the balance of payments crisis and how does it occur in reality. And also, we covered self-fulfilling crisis. Okay, this is the end of the lecture. So thank you for much. Thank you for listening. I hope you enjoyed the second lecture. So bye.